What we heard from FedEx yesterday concerned an awful lot of people. What they're seeing is overseas, but what should we be thinking about the U.S. economy right now?
Yeah, so we're definitely seeing a slowdown in the U.S. economy over the last few months. But we think that slowdown is temporary. We should, over the next 6 to 10 weeks, see things starting to move back. Slowdown probably largely caused by trade and the temporary government shutdown that we had.
So why do you think we move back? Obviously, the government shutdown's over, but you think there's a resolution on the trade front, too, and the tariffs come off?
Well, unless there are new tariffs added on, the effect that we've had has already started to take through to the economy. And at this point, unless there's some new development, we should see new manufacturing firms start to come back and jobs start to come back and a little bit more confidence in the economy.
You know, you think about the impact the tariffs have had on some companies. Boeing can point to some of these issues. You've got manufacturers who are using aluminum can point to them. The car companies will say that it's costing them about $1 billion. But you're not concerned about that as long as there's not additional tariffs that come on?
Well, starting July of last year, we put in, when we saw these tariffs coming on, a slowdown in the economy in the fourth quarter and the first quarter of this year. And so that's kind of hit like
but
our
it's like
general...
a one-off hit.
It's a one-off hit. And so it shouldn't be a long-term holding down growth in the economy.
Simeon, we're going to hear from the Fed today. And how much of what you are doing is going to be based on what the Fed may say today? How much of it is not an issue for you because they cleared up kind of a lot of what they were going to... we kind of know what the Fed's thinking now versus what they thought in December.
I think the issue now is the Fed really needs to ignite some increased inflation expectations. You know, if you look at the balance sheet unwind, they may announce that they're going to be wrapping up the balance sheet unwind and leaving it triple the size that it was before the financial crisis as kind of a new normal balance sheet, but an acknowledgement that, hey, it might not be that balance sheet that's suppressing the long end of the curve. It might very well be low inflation expectations. So the dovish stance, as much as anything, is going to try to get that yield curve to steepen again, which is not a bad bet. I mean, 2.5% is really unusually low on a 10-year.
Yeah, I mean, looking at it below 2.6% is kind of confounding people, unless you think that it's not anything here, it's something overseas that is tethering us to those lower rates, in which case the Fed can't do anything.
But even if it's an overseas issue, and, you know, we saw the dovish comments from the ECB just a few weeks ago, you're still talking about a normal 10-year yield that should be 2% above inflation. So are we talking about inflation expectations that are really at 50 basis points? So I think people are a little bit complacent about duration risk these days.
Alan, what do you expect to hear from the Fed, and what could be a surprise, maybe a low probability thing that we might end up hearing from them?
Yeah, so we're expecting them to move down to 1 rate hike this year in their expectations. That's down from 2 in December. In the minutes of the last FOMC meeting, nearly everybody had lowered their growth expectations. So we're expecting that to move down probably into the 2 range for this year. A surprise could be if they move all the way down to 0. That would be a big acknowledgement and a big move away from their talking about how the economy has been strong but cross currents. If you're moving all the way down to 0, you're moving away from that idea that the economy is really pretty strong.
Well, that would be bearish for the markets, I would imagine.
Certainly.
I would imagine that would be a spook, right? If he gets too dovish, that's an acknowledgement that...
I don't even know if that would be such a bearish thing,
really?
Just because, you know, multiples only mean something in the context of interest rates. I think it would be possibly enough of a catalyst to maybe even steepen the yield curve and maybe even support equity prices if there's a little bit of surprise on the dovish side.
Simeon, what are your best ideas right now?
You know, one of the things that we've been looking at is, you know, the waning economic expansion and its impact on corporate profitability. You know, margins are now at a peak even higher than before the financial crisis. So we're starting to look at companies that have very good returns on assets, but perhaps not such rich gross margins such that they can withstand a little bit of a reduction in peak margins. And the other thing we're looking at is how companies are returning cash to shareholders. A lot of hand-wringing about buybacks these days, but there's a key difference between buybacks and companies that say increase their dividends. A buyback from a company is actually telling you that their increase in profitability is temporary. That's why you do a buyback. So buyback companies a little bit at risk.
So buy dividend companies, not buybacks?
Exactly.
Are we going to hear anything about the composition of the balance sheet and what the Fed would target? I mean, there's been some made of that. The Boston Fed president indicated that would be important, the mix of 2s to 10s. The average duration is now 6 years on the balance sheet of the Fed. And that could really do a lot in terms of managing, so to speak, that yield curve.
Right. We'll probably hear a bit about their plans for the taper and how much they're going to slow that down. the reduction of the assets. But the composition may occur in this meeting, but more likely the composition stuff will be pushed off until the June meeting when we hear more about that. One point I'd like to make and that Simeon mentioned was inflation expectations. So right now, the core's preferred inflation gauge, core PCE inflation, is running at 1.9. Over the next couple months, given the data we've seen from the CPI and PPIs, that's likely to move down to 1.8 and then down to 1.7 when the February data is released. This is not the slow upward movement to 2% that the Fed is looking for.
Which means what?
Well, that creates a big risk that there's going to be no Fed hikes this year.
Is that a risk?
Well, you're looking at no
Simeon,
inflation, but at the same time, you are seeing wage growth decent.
Yeah.
And so that compression will continue. It'll be more acute later on, is basically what that forecast indicates.
Yeah, so wage growth has been moving up pretty strongly for the recent years. It's now, 3.4 for average hourly earnings, the best it's been since 2008, 2009. So we're seeing good movements on the wage front.
Simeon, you think that's a risk for the markets? Because I think there are a lot of people who assume that we're not going to get any Fed rate hikes this year anyway. In fact, you may even see a cut at some point.
No, I think diminished inflation expectations are a risk to risk assets, and we've got to fire back up those inflationary expectations. And the only way to do that is to get a little bit more dovish. That's the only way to fire them up historically.
Do you agree with that?
Moving inflation expectations is really difficult. I worked on the inflation desk at the Fed for 15 years, and how to move those expectations was one of the most difficult things that we really did not understand and is not understood in economics at this point.
Hey, Simeon, let's just ask you broadly about the markets right now. We are looking at much higher markets than we were looking at just 2 months ago, 3 months ago. What do you think? Does it feel like it's getting back to a proper level for you? Does it feel like it's getting to the point where it's a little tippy?
Yeah, again, back to the notion of multiples only mean something in the context of interest rates. So right now we're at roughly average PE multiples, but remember that average 10-year yields over a roughly similar time period are about 6%. So there's enough support given these levels of interest rates for current levels of valuations. But assuredly, profits are slowing down. We had 12% earnings growth in Q4. It'll be a stretch to get even that much in
profit growth is slowing down.
Profit growth is slowing down, absolutely.